The Bank of Canada continues to put politics before monetary policy, as we're going to demonstrate in this video. The Bank of Canada came out today and they came out with a 25 basis point cut. So just to look at this on a chart, oh my God, just look at it, guys. Wow, it looks like it drops so much here. Oh my God, can you sense the sarcasm coming from my voice? Yeah, so the Bank of Canada now down 50 basis points from 5%. We need to take a look at their measures of inflation to really get an understanding of whether they really care about inflation now, or they're more focused on the housing market and the banking sector. Obviously, we've had more money that has been injected into the repo market. Banks are hoarding cash. They don't want to trade these really safe mortgages, these safe and effective. We've heard that word before, haven't we? We've heard that phrase before. So anyway, these safe mortgages, they don't want to trade them as much anymore, apparently, as the repo market has been seizing up again. But let's get into what's going on with the inflation rate month over month. They don't care about inflation, guys. This is not about inflation, and that is their primary target, is inflation, as they have said time and time again, using their own words, that inflation is our #1 priority. And it's actually monetary stability, according to their website, that is their top priority, which again, this proves kind of isn't the case. If we look at the inflation rate month over month, you can see how it's actually been very strong here. And bear in mind, this data hadn't come out before they cut rates last month, so they didn't know that it had gone down 0.1%, which is a measly amount when you look at all of this. And obviously you can see that it's gone down little amounts before in the past before going up, but you can clearly see here that inflation has turned up, and obviously inflation is not really their top priority anymore. It seems like they have other priorities at play here, which they're not being honest about. I think it's more political than anything else, as you've got surveys that are coming out saying people desperately need interest rates to go down because of the high debt levels that we have in Canada. But anyway, if we get onto the core inflation rate, much of the same story. It's been ramping up throughout the year. And again, this data was not released before they cut rates last month. So they only saw all of this before they cut interest rates. So that is very interesting to note. So let's see what they're actually saying here in the mainstream media. So the Bank of Canada cuts key interest rate for second consecutive time, bringing overnight rate to 4.5%. The Bank of Canada cuts its benchmark interest rate by 25 basis points on Wednesday for the second consecutive time, a widely expected move that brings its policy rate to 4.5%. The rate cut comes as inflation moderated to 2.7%, with price pressures broadly easing. And again, they're talking about those year-over-year numbers, but when you really look at those month-over-month numbers, they don't look like they're anything pretty. I mean, you add up all these and you're pretty much at the Bank of Canada's inflation target for the year in just a few quarters. So it just goes to show how quickly things can change. And obviously the Bank of Canada and the mainstream media are just going with whatever makes them look like a sound institution, which we know they are not. So this came out before the rate cut. What a Bank of Canada rate cut on Wednesday could mean for your mortgage. I think this is more to do with what's going on here. The housing bubble imploding right now. And the Bank of Canada is getting worried because the amount of debt these banks, financial institutions, private businesses, and households are holding is at eye-watering levels, and it all surrounds the Canadian housing bubble, which is imploding. This is never a good thing because housing is not a productive investment for business capital. Barring a rare deviation, banks will then reduce their prime rate lending rates by the same percentage from 6.95% to 6.7%. Obviously, this was released before they cut interest rates, so that is what has happened, easing the cost of borrowing for Canadians, although very, very slight, not going to have a massive impact at all. Based on the average home price in Canada, $696,179, a homeowner would save $95 a month, according to ratehub.ca calculations, assuming a 10% down payment, 25-year amortization, and 5-year variable rate dropping from 5.7 to 5.45%. And again, you have to remember September here. Me and John Flynn talked about this on a prior interview that I'll link in the pinned comment. And the fact is that if you're on some of these variable rates, especially the fixed payment variable rate, which was the dodgiest mortgage and boom during 2020 and 2021 and 2022, that mortgage, you might not see your payment change at all because essentially you're in negative amortization. So all that's going to happen is your payment stays the same, just more of your payment is allocated towards the principal because the interest rate changed. But you're still likely miles underwater from the high interest rates, and still you could be going underwater because 4.5% is not that much different from 5%. So you still might not have people that are covering even the interest payment portion of their mortgage payment, which is completely insane. So a lot of people are actually not going to be affected by this. And I would argue that you also have the other side to this, which is you have more and more people that are renewing from fixed rates that are going to be faced with these high rates, which are much higher than when they took out these mortgages. So that kind of offsets any benefit that you get from the payments going down for a just very small segment of people. Remember, it's only going to be those people who had their payments adjusting, those people on those variable rate mortgages, not on those fixed payment variable rate mortgages. So it's very interesting, the dynamic. They make this out to be such a huge thing, but it's really not. And we're talking about 50 basis points. Again, when you look at the chart of interest rates, I mean, it really doesn't look like very much has happened. In fact, if you go back all the way to 2000, you can see here that in 2007, interest rates were around 4.5%. So we're still at 2007 levels, and home prices were drastically lower back then in Canada than they are right now. Nobody has ever seen interest rates and home prices this high before. So the payment strain on people is real, and it's going to lead to higher and higher selling pressure that I believe you're going to see. And basically what's happened with the Canadian dollar, very interesting. So if you look at this yellow line here, this is when they cut interest rates before. I said back then, because so many people were betting that the Canadian dollar would crash on the release of that, you could see some pullback and a rally, and we saw it drop initially, and then you saw quite a rally, and you got up to this high here, and now you've dropped and you've actually broke out of the range. So you're going back down now to these levels not seen since April of this year, which I'd argue, you know, rates were at 5% there. So I wouldn't say the Canadian dollar is crashing right now. At this point, it still seems to be holding this range, but we really have to look at what happens. If it breaks below this level in April, then yes, it could get really ugly really quickly, and it could easily do that based off the news. But if you're looking at what's happened so far, anticipating this rate cut, you can see that it's been incredibly weak. So you could actually expect another rally off this at some point. Even though it might not reach this high, you could definitely see a rally, that is for sure. So you've got 2/3 of Canadians polls say they desperately need interest rates to go down. A new survey says the Bank of Canada's recent interest rate cut did little to change Canadians' negative perceptions about their personal finances. The M&P Consumer Debt Index, conducted quarterly by Ipsos, dropped 6 points from the previous quarter to 85 points, which it says signals increasingly negative views on respondents' debt situation. 2/3 of respondents say they desperately need interest rates to go down, as more than half indicate they are concerned that rates may not fall quickly enough to provide the financial relief they require. And again, this just kind of emphasizes what we've been saying on this channel all along, which is the debt situation people have right now is much, much worse than these token rate cuts are going to do anything to impact their situation. In fact, their situation could be getting worse because they could be staring at a mortgage renewal. So I just want to quickly talk about what's happening with sales after last month's cut. So this is across Canada, coming from the CREA. And if you look, sales actually went down ever so slightly. And what actually happened to new listings? They went up. So a lot of people were anticipating that there was going to be a big rush into the market after they cut interest rates. And that's the complete opposite of actually what happened. And if you look at the residential average price, it actually dropped ever so slightly for Canada. I don't know why they've got these such basic charts for such a large organization and a housing market worth trillions of of dollars. They don't even have an interactive chart. Like, it's just unbelievable. But anyway, that's just the Realtors Association. So let's take a look at what's happening with gold. Obviously, gold is the inflation hedge against government stupidity. It's up 0.73% today against the Canadian dollar. And you can see what's happening. It's been on quite a strong rally, along with the US dollar rallying against the Canadian dollar. So again, gold is doing its job to protect people against government stupidity. This doesn't mean that gold is going to continue skyrocketing, but it's definitely a good thing to have if you're worried about your currency being debased, if you're worried about a currency crash. It's definitely insurance for that. Not an investment, in my opinion, but definitely an insurance policy. So that's what's happening there with gold. And then if you look at household debt to GDP, you can clearly see that the deleveraging has begun. You've started to see the deleveraging, which is never a good sign. In fact, you only have to look at what's happened on this chart to understand that that is not a good sign. When you see the chart peak out like this, it's never good. We've been through it so many times with the US chart, looking back to 2008 and what happened there. So you've got the people in debt who are seeing no relief, essentially. The economy is rolling over. And if you think a crashing currency will somehow benefit the Canadian economy, you are wildly mistaken, because a collapsing currency will do the complete opposite, because the currency is usually collapsing as a result of the economy being so bad or something happening like the gilt market blow up. And that did not result in a Russian investment capital into the UK when that happened, when the pound crashed. It was the complete opposite. It was the biggest flight they ever recorded. And you are seeing capital flee Canada in droves as the economic environment and the housing bubble just continues to implode. And we continue to see behind the veil of mass migration that this economy is incredibly weak. So anyway, if you've enjoyed this video, I'd highly recommend that you check out this video here. And if you're looking for a VPN to protect your privacy, go to expressvpn.com/market mania. That's the affiliate link for the VPN that I use, and I will see you in the next one. Take care.